Hello everyone, welcome back to my financial accounting series. Today, we're going to delve into the preparation of adjusting entries. Stick with me for the next 10 minutes, and you'll learn all about adjusting entries and how to prepare them at the end of each accounting period. So, let's begin with the accrual basis of accounting, which will help you understand why adjusting entries are necessary at the end of a period. Accrual basis accounting is a method where transactions are captured when they happen rather than when cash exchanges hands. This means that revenues and expenses are recognized when the transactions that cause them occur, regardless of when cash is paid or received. The accrual basis of accounting is required because it offers a more precise depiction of a company's financial activities by aligning revenues and expenses with the period in which they are incurred. This approach provides a comprehensive and informative view of the company's financial position and performance. It is crucial to understand that the use of the accrual basis is not merely a choice but a requirement mandated by generally accepted accounting principles, GAAP, and International Financial Reporting Standards, IFRS. By adhering to these standards, companies can provide reliable and consistent financial information to stakeholders, facilitating effective decision-making processes. Adjusting entries play a vital role in transitioning accounting records from a cash basis to an accrual basis. Rather than solely focusing on when cash is received or paid, these entries capture transactions when they occur. The purpose is to align the accounts with the true performance and financial position of a company at the end of an accounting period, whether it's a month, a quarter, or a year. There are 4 types of adjusting entries, and they can be categorized into 2 groups by their sources: revenues and expenses. First, accrued revenues. These are revenues that have been earned but not yet recorded because cash will be received after the services are performed or goods are delivered. This often happens when companies offer credit terms to their customers, allowing them to make payments at a later date. Credit terms could be ranged from few days to a month or even longer. This means that the products are handed to customers first and payments are received later. It is commonly known as account receivable or trade receivable. Second, deferred revenues. This occurs when cash is received in advance before goods or services are provided to customers. It is considered a liability because the company has an obligation to deliver goods or services in the future. Deferred revenues are also known as unearned revenue. At each period end, they must be adjusted to reflect the revenue actually earned during the period, along with the decrease in deferred revenues. Third, accrued expenses. These are expenses that have been incurred but not yet billed by the supplier or not yet paid. They are classified as liabilities because the company owes money to the suppliers for goods or services already received. The company will settle the amount in the future. Lastly, deferred expenses. These are initially recorded as assets when cash is paid to suppliers in advance for services that will be provided later. Examples include prepaid rent. It is also known as prepaid expenses. These are types of assets owned by companies as future economic benefits that the services will be provided to the company. At the end of each period, they must be adjusted to reflect the actual expenses incurred during the period through the use of the services. Now, let's walk through an example with Tom Limited as it prepares its accounts for May 2024. Here are some transactions that occurred during that month. Transaction number 1. On May 1st, 2024, Tom received $15,000 in cash from customers for a training course spanning 3 months, from May to July 2024. Let's look at the initial entries on May 1st, 2024. Cash was received in advance for the 3-month training course, so we debit cash for $15,000. At that time, Tom Limited had not yet earned any revenues because the services were yet to be provided to the customers. So, we credit deferred revenues for $15,000, which is a liability owed to its customers. Now, let's move on to the adjusting entry on May 31st, 2024. Tom provided the training course for the month of May, earning $5,000 of the total $15,000, which is $15,000 divided by 3. So, we credit revenues for $5,000, and it has already provided part of the services owing to its customers, so we debit deferred revenues for $5,000, meaning that such liability reduced by 1/3. To summarize this case, the revenues in question would be evenly earned over the span of 3 months, from May to July, resulting in $5,000 per month. As a result, the deferred revenues, which are accounted for as a liability, would gradually decrease from the initial amount of $15,000 on the first day, reducing by $5,000 each month. By the end of July, the deferred revenues would reach zero. Before we move on to the next transaction, if you found this video helpful, please give it a thumbs up and subscribe to our channel for more accounting tips. Transaction number 2. On May 31st, 2024, Tom sold football jerseys to a customer on credit for $1,000 with a 14-day payment term. Under the accrual basis of accounting, sales are recognized when the goods or services are delivered, regardless of when the cash is received. In this case, on May 31st, 2024, we credit the sales account for $1,000 to reflect the revenue earned from the sale. Additionally, we debit the accounts receivable account for $1,000. This action increases the accounts receivable balance, which represents the amount of cash we expect to receive from the customers in the future. Accounts receivable is considered an asset on the company's balance sheet. Transaction number 3. On May 1st, 2024, Tom paid $6,000 in rent to the landlord, covering 3 months from May to July 2024 for its office. Let's review the initial double entries on May 1st, 2024. First, we credit the cash account for $6,000 to record the payment made to the landlord on that day. This transaction decreases the cash balance as the company paid for the rent. Second, the company paid the rent in advance, covering the use of the office premises for the upcoming 3 months. This prepayment provides economic benefits in the future and is considered an asset. Therefore, we debit the prepaid rent account for $6,000 to reflect this asset on the company's balance sheet. Now, let's move on to the adjusting entries on May 31st, 2024. After the passage of 1 month, it is necessary to recognize the portion of prepaid rent that has been incurred as an expense for the month of May. Since the prepaid rent covers a period of 3 months, we allocate 1/3 of the total prepaid rent amount, which is $6,000 divided by 3, resulting in $2,000 for May. To accurately reflect this expense, we debit the rent expense account for $2,000. Concurrently, we credit the prepaid rent account with $2,000. This credit entry corresponds to the portion of the prepaid rent asset that has been utilized or consumed during the month. By reducing the balance of the prepaid rent asset, it accurately reflects the amount that has been utilized up to that point. To summarize this case, the rental expenses in question would be evenly incurred over the span of 3 months, from May to July, resulting in $2,000 per month. As a result, the prepaid expenses, which are accounted for as an asset, would gradually decrease from the initial amount of $6,000 on the first day, reducing by $2,000 each month. By the end of July, the prepaid expenses would reach zero, reflecting that such asset is fully utilized up to the end of July. Lastly, the electricity bill for May 2024 is $100, due on the 15th of June 2024. During the month of May, the company consumed electricity, even though the payment for it is scheduled for June. To account for this expense in May, we debit the utilities expense account for $100. Additionally, since the company now has an obligation to pay the supplier for the electricity consumed in May, we need to recognize this liability. Therefore, we credit the accrued expenses account for $100. By going through these examples, we can clearly see the significance of adjusting entries in ensuring that revenues and expenses are accurately recorded in the appropriate accounting period. This process allows for a more precise reflection of the company's actual performance and financial position for each period. That wraps up today's lesson. To recap, we covered the accrual basis of accounting, the importance of adjusting entries, and the 4 types of adjusting entries. accrued revenues, deferred revenues, accrued expenses, and deferred expenses. Accrued revenues, revenues earned but not yet received or recorded. It is an asset. Deferred revenues, cash received in advance for services or goods to be provided in the future. It is a liability. Accrued expenses, expenses incurred but not yet paid or recorded. It is a liability. Deferred expenses, prepaid expenses that are recorded as assets until they are used. It is an asset. In our next lesson, we'll walk through the entire accounting process, including preparing daily journal entries, making adjusting entries, generating a trial balance, and producing income statements and balance sheets. Thank you for watching. If you have any questions about today's video or financial accounting in general, please leave them in the comments below. I'm here to help. If you found this video helpful, please like and share it with. Don't forget to subscribe to stay updated with more accounting tips and tutorials. See you next week.